Welcome back to the Deep Dive, where we take your stack of information and extract the knowledge you need, usually before you even realize you need it. Today, we are staring down the barrel of the future. We're talking about the 2026 forecast for spending crypto.
Right.
It's no longer about just, holding assets in a wallet. It's about how you build a life, a mobile, borderless life, using those assets and free from all those old banking headaches.
That's the key mission today. I mean, for years, crypto has been this promise of decentralized freedom, right?
Yeah, the promise.
But the moment you try to use it in a coffee shop in Lisbon or pay for a flight in Tokyo, you just slam into the ancient rules of the financial world.
Exactly.
We have a crucial source today, a traveler's guide to crypto cards. And our deep dive is really to figure out how these tools are actually achieving pay without borders.
Yeah.
And what you need to know to leverage them.
And the source material is a perfect roadmap for that. It maps the problems first, all that friction that just sabotages the global traveler, and then it pivots right to the solution.
The essential features that define this next generation of financial tools.
We're giving you the shortcut to understanding which infrastructure is already succeeding at bypassing those centralized gatekeepers.
We're moving the conversation from, theoretical freedom to functional, practical liquidity. It's about making sure that your digital assets are just as spendable as cash, no matter where you happen to be standing.
Okay, let's unpack this by starting with what I'd call the institutional betrayal. We need to focus on those core pain points that drive people away from traditional banks and toward these new crypto solutions. I mean, think about the last time you were traveling and your card was just declined.
That feeling.
That feeling of immediate total helplessness.
And that feeling isn't a bug in the traditional system. It's a feature. It's designed for control, not for your flexibility.
Right.
Our source material outlines 4 massive institutional frictions that kill global spending.
Yeah.
And the most frustrating one, the first point, is that traditional banks simply don't travel with you.
I understand the feeling, but can you elaborate? What does "don't travel with you" actually mean in practice, like when the transaction fails?
It means the bank's entire framework is, well, it's intrinsically local. When you travel across continents, your spending patterns instantly look unusual.
So it triggers the fraud alerts.
Instantly. And their fraud department operates on their local time zone. So you're trying to check into a hotel in Southeast Asia at 1 a.m. local time, but your bank's security team is asleep in New York.
Oh, wow. I never thought about the time zone issue.
So the system just decides to freeze your account because it can't verify your spending instantly, 8 hours out of sync. It's an immediate passive block on your own money just because you changed locations.
And even if you manage to avoid that, say you call them ahead of time, the source points out you run headlong into the second problem: constant cross-border friction.
Yeah, that huge red S-stop-P barrier they show in the visual.
What's behind that barrier?
That barrier is often built of regulatory silos. We forget that traditional finance, it's layered in fees and complex legal frameworks designed to track and restrict how capital moves.
So the cards themselves aren't built for it.
Not at all. Traditional cards are inherently designed to collapse the moment they leave their home jurisdiction. Every time you cross a border, the transaction becomes exponentially more complex, more expensive.
Because of currency conversion and all those hidden fees?
Currency conversion, bank-to-bank messaging, intermediary fees. The card might work, but it works slowly, expensively, and it often fails entirely when things get too complicated.
But the real kicker, and what I think is truly absurd for the rising population of global nomads, is that third barrier: being trapped by the proof of residence requirement.
Oh, absolutely. This is the institutional mode. It's not just an inconvenience. It's a systemic barrier to financial inclusion for this whole growing workforce.
People who intentionally don't have a permanent physical address.
Exactly. Traditional banks demand local utility bills, local IDs, verified local addresses just to open or maintain an account. Imagine trying to prove you're a local in Bali when you get your mail in London, just so you can access your own money.
It's insane. And you're saying crypto cards just bypass this?
They bypass this entirely because they rely on the underlying decentralized asset, not your geographical location or some utility bill.
Wait, so we're talking about circumventing decades of entrenched regulatory residency requirements simply by changing the asset type.
That's the real story here.
It's so intense that it basically forces mobile people back into using cash, which is just completely backwards for a modern financial life.
Precisely. And the fourth friction, which underpins all of this, is just the high cost. the foreign transaction fees. The system is designed to penalize mobility.
They clip a percentage every time you spend.
Every time. And it's often hidden in terrible exchange rates. So given those four massive roadblocks, the time zone freeze, the silos, that proof of residence trap, and the fees, what does the solution look like?
Right. This is where it gets really interesting. The fundamental shift offered by crypto cards. What is the core value proposition that gets around all of that friction?
The core value prop is instantaneous liquidity combined with global reach. The source highlights that crypto cards allow you to pay anywhere with crypto. And that's not just a marketing slogan.
It's a functional description.
It's a functional description of the mechanism. The card isn't loading up fiat ahead of time like some old traveler's check. It's acting as a real-time conversion engine.
Okay, I see the source calls it a conversion engine. How is that different from a standard prepaid debit card? What makes the conversion instant?
The difference is it's atomic and immediate. When you swipe a traditional prepaid card, you're spending fiat that was already loaded. When you use a crypto conversion card, you are spending the crypto from your linked account. At the exact moment the terminal asks for payment, the card provider instantly executes an atomic swap.
So it converts, say, Bitcoin or USDC into whatever the local currency is.
Exactly. Into Mexican pesos or euros or whatever, and passes that fiat to the merchant over the Visa or MasterCard network. It happens in milliseconds.
That instant conversion, that atomic swap, it must address the volatility issue, right? If it's instantaneous, the risk of Bitcoin crashing between the swipe and the payment is gone.
That is absolutely correct. It either locks in the exchange rate at the point of sale, or, and this is happening more and more, users just hold stablecoins in their card wallets.
Which eliminates volatility completely.
Completely, while still bypassing the traditional banking system. That reliable liquidity is what makes it a genuine global financial tool.
And this leads us to the 3 essential features for a strong travel card, especially as we look toward 2026. These features have to directly negate the problems we just talked about.
Absolutely. The first is non-negotiable: worldwide acceptance. A crypto card has to leverage the most established global payment networks, Visa or MasterCard.
Because if it uses some niche network, you're just trading one restriction for another.
You haven't solved the problem at all.
Second, something we all take for granted now, compatibility with digital wallets, Apple Pay, Google Pay.
This is all about usability and security. People expect tap and go. If you're traveling, dealing with physical cash and cards is inconvenient and, frankly, less secure.
Digital integration is just the standard now.
It's the standard for borderless financial freedom.
And the most crucial feature, the one that directly attacks that 4th friction point, the punitive cost of mobility. Zero tolerance for hidden costs.
Yes. No hidden border fees, as the infographic puts it.
This is where you save the most money.
This is the feature that saves the most money for the true global mover. I mean, traditional banks often charge a 3% foreign transaction fee if you're moving, say, $5,000 a month through your accounts while abroad.
That adds up fast.
That's $150 a month, $1,800 a year, just for being mobile. A truly independent crypto card has to offer transparent, low, or non-existent fees with exchange rates that are close to the real market rate.
Okay, that clarifies the mechanics and the feature checklist. Let's move to how this is all actually implemented, because not all crypto card companies are playing the same game.
That's a vital point. The business models really affect your experience as a user.
Yeah, the source material breaks it down into 3 distinct categories. Knowing the difference dictates what kind of risk and flexibility you're taking on.
It does.
Let's start with the most intuitive one, the exchange-based cards.
These are solutions tied directly to a single existing crypto platform. So think about the cards offered by some of the major centralized exchanges.
The advantage there is convenience, I assume.
Totally. You can spend assets immediately from that exchange account. But there's a massive trade-off. They are often heavily geographically restricted.
So if the exchange gets forced out of a country because of new regulations, or they just don't have a license there?
Your card fails entirely.
So if I'm using my exchange card in the US, but then I move to, say, Turkey or parts of Asia, the whole service could just be suspended.
Well,
and I'm stranded.
Precisely. The geographic restriction of the exchange becomes your single point of failure. The card's utility is only as broad as the exchange's legal footprint.
Which is why the second category, FinTech cards, emerged.
Right, the independent players. FinTech cards are independent solutions designed specifically for global payments. They're built for purpose.
Meaning they aren't tied to one specific exchange's regulatory problems.
Exactly. They might connect to various wallets or let you bridge assets from different places, but their primary goal is that cross-border utility, that zero-friction experience.
And then the third category is sort of the plumbing that makes it all possible. White label cards.
These are fascinating because you often don't even see them as an end user, but they represent the true scalability of this whole movement.
So they're like the infrastructure provider.
Think of them as the software as a service, or SaaS, layer of card issuance. White label providers have the core infrastructure, the compliance, the licenses, the tech that other brands can use to launch their own custom crypto cards.
Ah, so a smaller wallet provider could launch a global card without having to build a global banking backend from scratch.
Exactly. It allows the smaller, more innovative players to compete globally with the giants.
That makes perfect sense. It lowers the barrier to entry. Now, the infographic highlights a specific example that seems to embody that ideal fintech model, PintoPay. It's described as built for global movement.
And that's the direct answer to all the friction we identified. The key detail they provide is quantifiable. The card works in over 150 countries with a promise of zero border friction.
150 plus countries. That's designed to overcome the regulatory silos and that proof of residence trap at the same time.
It's engineered to move capital seamlessly. It prioritizes the user's need to spend over the bank's need to control.
It really sounds like the technology is way ahead of the regulatory structure. The market has figured out how to make crypto spendable globally, forcing the old system to adapt or risk just being bypassed.
That's the fundamental shift. The technology is rapidly overcoming what used to be considered immutable hurdles, the geopolitical boundaries, the residency requirements. This movement champions financial freedom and seamless access.
The conversation's changing from, can I spend my crypto, to which card gives me the most sovereignty?
Exactly.
So what does this all mean for you, the listener, in practical terms? I think the most valuable takeaway is this. Spending crypto is no longer some niche, complicated action for tech wizards.
Not at all. It is now a fully integrated, viable, borderless financial pathway. But, and this is a big but, your success hinges entirely on your due diligence.
Right.
As we look forward to the 2026 landscape, you have to ensure the card you choose meets the criteria we highlighted. Prioritize true worldwide acceptance, strong digital wallet support, and a documented, transparent commitment to having no hidden border fees.
Anything less is just a compromise that invites the exact friction crypto is supposed to eliminate in the first place.
You'd be right back where you started.
The shift is powerful. We're watching the market move away from banking restrictions and rigid geographic blocks toward instant, functional, borderless crypto conversion.
The individual is regaining control over where and how they use their capital. It's freeing it from the confines of any single nation-state's rules. Financial sovereignty is becoming a practical reality, not just a philosophy.
And that leads us to our final provocative thought for you to chew on. If the practical, physical barriers to spending crypto worldwide have been solved by solutions like this, if the technology has successfully bypassed borders and bank offices, what is the next frontier of financial freedom that centralized systems will try to restrict? And how will decentralized solutions respond? We've solved the geographical problem, but what about the data sovereignty problem, or that regulatory requirement to verify identity? What aspect of this new global financial architecture remains tied to those legacy systems? Think about the implications of truly borderless finance on the future of global economic policy. We'll see you next time on The Deep Dive.